All right, stocks were really quiet yesterday after the CPI report because of today. The market was really looking forward to the retail sales number and the Walmart earnings, both kind of key indicators with the health of the consumer. We also had jobless claims, which also kind of gives us an idea of where unemployment's going, and they all were great. There was some manufacturing index that didn't look so hot, but the consumer is strong, and they really sent the market flying. And yesterday we talked about an inflection point of the best case scenario, worst case scenario. Well, we got our best case scenario. We got our breakaway gap. We moved up higher today. Ran away from the open, not to a large degree, but enough to be bullish, and we have a lot of really good signals. We're moving further along that path. Unfortunately, like our trade idea of the day actually looks exactly like what we want the S&P to look like. So that's why we're making a trade on it. The S&P is not quite. So you're going to see the difference of what we're seeing in the S&P and what we're seeing in that trade idea and what we want to see in the S&P. So, and you'll see the difference and why there's still, again, we have pretty high odds now. Because of today's breakaway, we have pretty high odds of a new bullish run starting. But we still have a low probability odds of a failure because of how some of these indicators are looking, and we'll see why, and we'll see what we need to see within the next day or two. Tomorrow with options expiration, and early next week to really kind of change that narrative and get us going, right? Get us going to the upside. So let's break that all down and go ahead and get started. Today is Thursday, August 15th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Coming down to the bottom, you can see some of our Market Outlook, some other posts you can see come down to the bottom. Click this heart, it opens up this tab, hit that like button. Same thing here, click this thumbs up icon. It opens up this tab, hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's take a look at the S&P 500 with the market forecast indicator first of all, and we can see the intermediate line is crossed into the upper half of the chart, dark green shading. We are now more than a 1.25% above the moving average. That's actually brought the moving average higher already. So you have a green line now. So we have dark green shading and a green line, just like that. That is a new bullish intermediate posture here. Nice little breakaway gap that we had here this morning. Good chance of holding. We are sitting below last week's highs, or actually a couple weeks ago's highs, but that's okay. We have a good chance of breaking through that. You would expect, considering the strength of this momentum that we have, that we'd have a good chance of breaking that. The near-term line, speaking of that, the near-term line is at very high levels. That would give us a good opportunity for that to break through. Very bullish near-term high. The momentum line is not very strong, but now it doesn't have to be now. Now that the near-term line's up there, we just have to be aware of any significant low that could drop the near-term line too far to the downside, but not a significant concern. The market sentiment line's falling, but still in bullish territory, and maybe a few days away from the intermediate line crossing above that, which you can see is obviously a good sign when your intermediate line is above the market sentiment. That's when you have these good long intermediate rallies when it's up there. So far so good on the S&P. The Nasdaq got a bear tag. So it's kind of at that inflection point. We're not very far above the moving average, only 0.75%. So, and we're not in the upper half of the chart. So not as bullish on the Nasdaq 100, though it did go up 2.5% today. The gap you would not consider to be a breakaway gap because we didn't break through any significant resistance levels like we did on the S&P 500. So you are still at an inflection point there. Again, it can be a continuation pattern, just like these bull tags were in reverse, right, to the upside. But it also can be the start of a new bullish trend. So as of right now, considering what the S&P looks like, you would expect that to be the case, that this would be the start of a new bullish trend as we head into options expiration. If you look at the Russell 2000, it also has not been as bullish, so it did also go up 2.5% today. Not nearly as bullish of a pattern yet. It's still light green shading because you're you're not even out of bearish territory yet. Your market sentiment's lower than the S&Ps. It's actually almost in the lower half of the charts, out of bullish territory there. So pretty neutral. You can see we try to break out of this neutral pattern, and we obviously didn't hold that breakout. And you're still below the moving average by about 0.5%. The near-term line also set up for a potential bearish near-term peak, so we still have that as a potential there. Your Dow Jones is looking more like the S&P now. Strong bullish posture, dark green line on the moving average, and tomorrow you'll have dark green shading as the intermediate line, most likely, barring a significant drop tomorrow of like 2% or more, which is unlikely. That's probably the only thing that would keep it from getting above 50. So most likely you'll get dark green shading and that green line tomorrow on the Dow. So things are looking really good here. Let's take a look at the weekly chart. So bear with me 1 second while I do that. Getting a good bullish reversal pattern, kind of a transition, and it's looking really strong. You can see it's a good strong bullish candle. So it's a transition candle that has a good chance of being a reversal candle. Considering the green arrow and the strong bullish candle on the regular chart. It's not the biggest body yet, but we can build on that next week. You would expect that we'd build on that next week, considering that we're currently finishing close to the high of this long upper shadow. And you look at something like the Russell 2000, and you also have a transition candle. Again, its weekly candle is not as strong, but still pretty bullish. So a good opportunity, and again, it's still a bearish candle nonetheless, but it's a transition candle with decent odds of having a reversal. If you take a look here at the 3 green arrow charts, you can see 3 green arrows across the board, except for in the Russell, but you're only maybe a day away from that being 3 green arrows. And you know, you got on the S&P 500, you got above average volume there. On the Dow Jones, you're pretty close to being average. On the NASDAQ, you're a little bit below average, and you don't have the green line yet like you do on the Dow and the S&P. And then the Russell, you can see again, you probably will get a green line here because you have to be above a rising moving average for it to be green. So probably will get that, and you had strong volume today. So we're probably 1 day away from a good 3 green arrow signal on the Russell 2000. Here's your let's go to the 2-line version of the 3 green arrow chart. You can see that's the breakaway gap. We broke it through. This was also the 62% retracement of the Fibonacci of this decline. So we broke through there, and you can see too, like if we were, let's see here, let me make sure I got the high point here. There we go. So there's the high point down. So you can see we're sitting right at that. We broke above the 62. That's the breakaway gap. Here, let me auto that. We broke above the 62% and the 30 and 50. So you broke. That's the breakaway gap. You broke above resistance during the gap, and then now you are above these moving averages. The MACD is now positive, barely, but it's positive. Stochastics is in bullish territory. Like I said, you had pretty decent volume on the breakaway. And now remember I said that a retracement starts when you break above. In the case of a bullish retracement, you break above the 23% retracement. That's when the retracement starts, and it ends when you get back below it, or you get above the 78. So that's how close we are to getting above the 78% retracement. Go ahead and remove that. You can see we're not quite there yet on some of these oscillators, but we're getting better, right? We like to be above 30 on the positive, below 20 on the negative. And they have crossed, though they're still right around the 25 levels. So again, still potentially at failure levels. So we need another day or two to rectify that. Same thing here, like we're still at failure levels. Like we failed over here at 58, 59 and came back down to lower lows. So we need to get above 60 so that we can really solidify the change in trend. And you can see we're above 100 on the CCI, but you really like to be above 150 to really solidify the new intermediate trend that we're trying to get started here. So again, still at failure levels on those. The Ichimoku cloud is above its cloud, right? The S&P is above the cloud, above the blue line. The bearish trend now, these two lines have now hit zero. Remember yesterday we talked about it. Did not hit zero yet. It was still in the cloud. Now you're above the cloud, and they both have hit zero, and you're above the blue line there. The rate of change is still negative and probably will be negative unless we get a really good, we have to break in the next 4 days. We have to be above this high point to get, because the red line is today's close. So if we're going to be above, it's plotted 26 days prior. So if we're going to, it's basically a 26-day rate of change. So we have to be, above, this 565 level if we're going to get a positive rate of change in the next 4 days. Otherwise, you can see now once we start to drop, it gets a lot easier as long as we don't start to drop along with it, right? Remember, when you have a pink line, because you've had an intermediate decline, right? You have an intermediate decline produces. See that the cloud is plotted 26 days forward. So when you get an intermediate decline, one of the signs of that is a pink cloud. So by the time, obviously we need to turn green, and we're close to turning green there. But by the time you get to the pink cloud, so within 26 days, you should be above it, right? So that's kind of a sign that, that it was just a pullback, and we have a good chance of moving up higher. So again, the more you're above the cloud, the more likely that is to happen. And so that we have a good chance for that. Obviously the Qs, you can see the Qs are not quite above its cloud. So we're not quite through that level yet. You can see when you look at its retracement here of this decline that we've had. So we are not above this. We're barely above the 62% retracement. And like I said, we have to get above the cloud to be above the 78% retracement level. Let's take a look at the small cap index, and you can see again it is above the cloud, but also has had enough of a pullback to produce a pink. And you can see we actually have an intermediate trend strength, bullish trend going. So we haven't really pulled back very much on IWM at all. Let's take a look at the Bollinger Bands. We finally did get in the upper quartile of the bandwidth. Again, still at relatively failure levels. You like to be pushing up against the 100, like in the 90s, to be really strongly bullish, and we're not there yet. The momentum is less negative, and you can see the bands look like they have a good chance of actually staying outside of the Keltner channel. So, and we are obviously still easily below the Keltner channel. You'd like to get above it to really change the trend and get going. You can see when you get above the Keltner channel, you can be above it for a very long time, and that's kind of what we'd like this. What we would like to see here. If you look at the intraday move on the chart, you can see a higher high, higher low. There's your breakaway gap. That's what we're hoping. It was a pretty decent sized gap, 2 standard deviations to the upside for the past year. So pretty decent sized gap there. That's like what we want to see, and we broke away. We ran away from the open. That's what we want to see as well. So we do not want to fill that in at all. If we fill that in, we're most likely going to fill this one in, because this is more than likely a common gap there. So we can avoid that, and you can kind of consider that a runaway gap. Either one of these two can be considered runaway gaps, and but most likely we'd fill that in if we filled this one in. So we want to avoid filling today's gap in at all, which you don't typically fill breakaway gaps in very soon. They're the good ones. Both of those, runaways and breakaways, are the good gaps. We don't have our new 4-week high point yet, but you can see how close we are. So we're getting there to that good bullish signal. We have gone way up into the 90th percentile. So that's how close we are to the new 4-week high point. We are way up here in the 90th percentile. So very, very strong move to a very strong level. The NASDAQ 100 is barely above the 80th, so that's not bad. The Russell is not so great, right? So we're not quite there yet on the Russell 2000 like we are on the S&P 500. Again, I showed you the volume was pretty decent. The range was 4.48 points, but you have to include the gap, so 543.75 to 548. So we had another 5 points. So you are above average on the volume, about 9, almost 10 points on the range. And then you can see the volume down there, almost 61 million. So when you look at those in context, it's pretty high, which is what we want to see. And you want to see that. Now we can start to get lower ranges. Now that we're above moving averages, we can start to get lower ranges. But you need good, strong moves to get the escape velocity, right? When you're below moving averages, to get going, to change the trend. And it appears that we've gotten that, so that's a good sign. And now you want to break the 1.5% level, break back down eventually below the 1% level, and we can really solidify the beginnings of this new trend that we had. And same thing with volatility, it's just collapsed. This is, again, the biggest 8-day collapse we've seen ever in the VIX. We're down almost now below 15. So just like that, in fact, we were a little bit below 15 today at 14.88. So, and we were a little bit below the 85% mark. We're sitting right on the 85% mark, which generally has not been too oversold, but has been pretty much all year. This has been the low point of the VIX all year long. The VVIX is still relatively high, so it hasn't collapsed as much. It obviously got to a pretty decent peak, whereas the VIX kind of came off of its highs. The VVIX didn't quite do that. So, and obviously getting back below 100 would be a significant change as well. At least we're about below 110, where we're still susceptible to big jumps in volatility to the upside. So, but now, again, we need to break that 100 level, and we'd feel really good about that trend too. So things are moving in the right directions. Even if we're not quite 100% there yet, we are definitely moving in the right directions for a bullish move. We do need to be aware, albeit those odds now are falling. I told you before that I was expecting a failure. And obviously we've continued higher. Good reaction to the retail sales, right? Like we said earlier, that can change things. And so that's a good thing. That's what we wanted to see. We want to see the markets go higher, and we got that. So we're not out of the failure woods yet. Like, the odds are much lower, but we still have some signals that suggest we're still there. So we need to rectify those before we can say, full on dark green shading, green line, 3 green arrows, away we go to the upside. Right now, let's take a look at what's driving a lot of this rebound. They continue to see this continued rebound that we saw today. You can see a big drop in, in bonds. So back to that negative correlation between bonds and stocks, right? Which means we're back to a deflationary environment where yields will be falling instead of rising. But that's okay. Like right now, they're rising, and that today they went up, and we were relatively bullish. Well, obviously we were really bullish on the equities. You can see small caps, large caps, everything went up, 2.6%, 2.5% today. International equities underperformed, but they did okay. Strength in the dollar kind of kept that. Commodities rebounded in a big way today. That's a good sign for risk appetite. And then you can see bonds were down. If you take a look at some of the charts for like TLT, again, they have been pretty bullish, and we are above a major support. So one day doesn't change things, and you can see TLT actually came off their lows of the day today. And then you look at like DXY, and you can see it's very oversold, and it rebounded. And typically, the dollar is not very correlated with the S&P 500. So when you look at its correlation chart here with UUP, you can see the UUP is, it has been positively correlated, but it's generally been negatively correlated with the S&P. So you want for this dollar, the S&P to go up, like you see right here in purple, you want that dollar to be going down. That's the ideal scenario. And so the dollar has been going down, but it has been, we haven't been too strongly bullish on equities. We've been bearish during this good chunk of this trend. There's been a few periods, like right there was a bullish move, and then you can see, this period has been a relatively bullish move when we've come off of this. So right now there is no correlation over 2 weeks. And the dollar is expected, the seasonality for the dollar is to be bullish now going into the end of the year. And obviously if the S&P is going to be bullish too, and if the dollar does go up and the S&P does go up with it, we'd have to keep this positive correlation, which, as you can see, is relatively rare. The commodities, however, commodities here, you can see they do have a positive correlation with equities, and so their rebound today was very welcome. You can see here the move still above the 17-day. The MACD is positive, moving higher. So we want to see commodities get back above their 200-day. Like, remember, when commodities are below the 200-day moving average, they're in correction mode. And when they get below their 200-week moving average, they're in bear market mode. So we want to avoid that because you can't have a bear market in commodities and a bullish market in equities, right? They tend to go hand in hand because of their positive correlation, as well as you can see here. If I were to bring up that correlation chart and do a little bit longer, do a weekly version of that correlation. If I were to go out to a weekly chart, you can see it's generally a positive. It hasn't been too positive here lately, but it's returned back to a normal positive correlation, and that's what we want to see, right? So we want to be able to see commodities really kind of move. Commodities can go higher without equities, but it's hard for equities to go too bullish without commodities, right? And we've had a pretty good this pretty good move here on the S&P. Since the end of last year's without, again, a strong move higher, just one little move higher here in commodities. So we've been negatively correlated, but that's not the norm, right? That's not the norm, especially if we're going to be in a bear market mode with commodities. We do not want to be we don't want to be in a bear market mode with commodities because that will put some pressure on this upward move in equities. So it's a welcome sight to see commodities do so well, and that's what we want to continue to see. We also have pretty good breadth today. It's not the best, right? We haven't really taken off. I did tweet out about the breadth thrust indicator. You can see we are at least barely above 35, so that's good. We want to build on that. The breadth thrust indicator we're not going to get because we never did get below 40. So we weren't that bearish, which is crazy. We were down 8.5%, but we went down so far so fast we never did get below 40. We got to 41.3. That was the lowest point. You have to be below 40 to get a breadth thrust indicator. This is the only other time in the last 5 years that we had any kind of pullback, whether it's pullback, correction, whatever. The only other time that we also didn't get below 40 was over here, where we also got in September 2021 to 41.3, incidentally, about the same level we just barely got to. And that was it, right? And the difference there is the 20-day average was relatively low because we weren't that bullish during the bullish rally there. We were relatively bullish here. We were at 56% on this bullish move, and we even stayed pretty bullish despite the decline. And we had a brief dip, and we're right back up to 56%. So it really doesn't matter now if we get up to 60% because we didn't start below 40. But the new highs and new lows, if you take a look at the new lows, we were down at 6 earlier today. That would have been an extreme if we would have stayed at 6. So we ended up only at 15 or 15 new lows by the end of the day. This is one of the things that this is an intraday mark, so it builds throughout the day. So you are going to have fewer early. We stayed at 7 for a long time. It picked up right at the very end. But still, you can see how low that number is, and again, it gets pretty low in the single digits even when you are near peaks, right? That's when you tend to get the lowest levels. So that's again something I think we'd like to see this actually pick back up. So that you have some runway. You can see, during this whole rally, we were up pretty good, decent that entire time. Remember, we didn't have a whole lot of good breadth here. We had a lot of new lows, but even during this rally, you had some pretty decent amounts of lows. So we'd like to get back up, right? Because if we're too low for too long, that's too extreme, and that ends up basically marking the low. You can see the new highs. We did jump back up. We're not back above the moving average. You like to be, because that's again, that's when you really get bullish, is when you're above these moving averages and you get up there, and you don't want to spike too high because that tends to be the peak, or at least close to a peak. All these peaks here pretty much had some spikes in the new highs, but we do want to get above that moving average. That would be the ideal, and kind of get into this 200 to low 300 range. And so again, not quite there, but close. The reason is because the average is so high. Like, we've never had an average this high on a pullback. For years, we haven't had a high this high, as you can see the blue line on a pullback here. So that's partly the reason why. Usually at 146, we'd be above these highs. We just, again, it was such a short pullback that the bounce has been relatively easy because at least it hasn't been producing the bullish signals, because we haven't had enough of a washout mode, really. to get down, to bounce up off of. And obviously, when you look at the difference between the new highs and new lows, also when you take into account the NASDAQ, that was just the NYSE, you can see we are above the net new highs and lows. We are above 100, which is that blue line, and we're above the moving average. So it's not very high, but it's high enough to be bullish, right? That's a good opportunity for a bullish trend. So we have enough breadth. We are above the 60% level at 334 now. The average is above the 60% level. So remember, this is also the lowest average we've had, the lowest dip on the average that we've had during a pullback. In fact, we had a much bigger dip on the average during this pullback, and then we had a lower dip on the rally. We didn't even have that low of a dip here because it was so fast and such a big V bottom up to the upside. So right back up to above that 60% mark, good sign. That's a good sign. So breadth is looking pretty positive across the board, as well as the money flow. The money flow also looks relatively decent. We are back above these highs, and the money flow is also above these highs, barely. We're still kind of at failure levels here, so we need to get above 60. But that's looking better, right? At least we're above 50. So again, we have good signs pointing us in the right direction. Part of the reason why we're not, all the way there is because really it's been a one sector move. That continues to be the case here today. Consumer discretionary joined the party today, finally. As you can see, is technology and consumer discretionary were the only two sectors outperforming the markets. But if I were to again go back to the move off of the low point, so that first up day, again, it's all technology, 11.65%. That's the only sector outperforming the market. Discretionary finally is now at least matching the market. Financials were doing pretty good early today and then lagged by the end of the day. And you can see the safe havens down here at the bottom along with materials. Materials had a decent day today, but that's because they were the laggard during most of this rally. When you look at the rotation graph, it is pretty much all technology. It's the only one gaining momentum. Discretionary is gaining a little bit of momentum, but it's pretty much technology is gaining all the momentum. It's got the highest momentum. It has the highest momentum. Discretionary, communication services and staples still has pretty high momentum. They're just losing it. And then utilities and real estate have the best relative strength, though again, like I said, they're losing it. Not losing it as much. They've lost a lot of momentum, but they're still not quite there. And you can see the chart here of XLK really ramping up here above its 17-day average. The 8 days about to cross the 17. The ratio chart of XLK to SPY is not quite above its 50-day yet, and you can see we are coming off of. This is the all-time low for the relative strength chart on this RRG chart for XLK. So this is taking a lot of momentum to just get us off of the low. So that's we talked about before. It will make it difficult for XLK to get all the way over here to 100 without rolling over like this and then coming back down in the blue and back into the red before making a second run, which usually happens when you are that low, coming off of such a significant low point there. So we'll see if that ends up being the case. When you look at, we need XLK to continue to outperform, because that is what drives the market right now. That's where the three biggest companies in the S&P are. They're all in that sector. It's a large, it's a large percentage of the market. Those three stocks are a large percentage of the market. So we need to get back above these moving averages. Continue. This is actually a weekly chart, so let's get back to a daily chart here. Get back above the 200-day moving average. We had broken below the 200-day. As you saw on the other chart, we're still below the 50-day, which is actually still above the 200. So, we're still below the 30. We're above the 17. So we need to continue and break through. We're pretty positively correlated here. The MACD is really moving up higher off of very low levels. The long-term PPO avoided falling below zero so far, but we're not out of the woods, right? We need to continue. The XLK needs to continue pushing higher, which means, right now, those are the stocks that we want to continue to be in. When you look at the Mag 7 charts, the Nvidias of the world, Apple, Microsoft, these companies here, Broadcom right here, AMD is another one, Adobe is another one, Qualcomm. These are all the companies that will break through and lead us higher if we're going to be higher. And then you can expect XLC to do pretty good too. Google is what's really limiting XLC as a whole. Meta and Netflix are doing pretty decent there. And then you can see Tesla and Amazon are doing pretty well as well. They had been lagging, which is why until today, which is why XLY has been lagging. And XLY, remember, has really been struggling relative to XLP. And still is below, a good breakout move today, good above the 17, but we need to build on that and get above these averages up here for us to really change the trend. And we're still very, very far away from that. All right, that brings us to our trade idea of the day. It's on Ross Stores. Let's pull up Ross Stores here. Ross Stores looks, in a lot of ways, like what we want the S&P 500 to look like, right? So a good breakout move, just like the S&P, breakaway gap. Earnings coming up here, the intermediate lines rising, near-term lines in bullish territory. Good move by the momentum line. You can see a good change in the long-term trend for Ross. The weekly charts got a transition candle with a good, strong bullish candle and the green arrow. So that's a positive development. Obviously, you have 3 green arrows on the chart today. We've had above average volume as well to support that, and the green line already on the moving average, so that's a positive development. You are above all these moving averages, right? You're above the 30, your point of control, the 30 to 50, so good breakaway gap there, good momentum. The MACD is positive, stochastics in bullish territory. Then you look at all these other oscillators where the S&P is still at failure levels. The Ross is not. You're above 30, below 20 on the DMI. That's perfect. The RSI and the CCI, you're above 60. You're above 150 easily, almost 200 on the CCI. So that's perfect, exactly what we want to see. When you look at the Ichimoku cloud, we are right there, almost at a positive rate of change. We're above the cloud. We lost the bullish trend, so that's good. When you look at the Bollinger Bands and the Keltner channel, again, we were at failure levels in the S&P. We're above the band and above the upper Keltner channel. So that's exactly what we wanted the S&P to look like, and that's what we're getting on Ross. So what I decided to do there was to do a bullish trade. So we're going to sell the 30 delta right around the low, right around the mid. That's the only one that's close to the mid 30s delta, and then buy one strike away. This is what it looks like here. So it's again right around a normal risk for this, and about a 1.5%. A 1.5 to 1 reward to risk ratio with really good flexibility on timing, especially with earnings coming up. We want to have some flexibility there, and it's looking pretty good. So as long as we continue higher, you can see the bandwidth here. So we have to get to the 155 strike, and you can see the bandwidth is to 163 by September. 155 is easily above the value area and above recent highs, so we'd have a very good chance of getting there if we were to continue this breakout move that we've had with this breakaway gap, especially with, like I said, the earnings coming up after expiration next week. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all tomorrow.